And let me just tell one thing to my learners that I've read Joy of Compounding. I'm almost at the fag end of the book because I've used it as my life textbook. I have not just read it for the sake of reading. Every day I have a target of reading certain number of pages. And this book is not about only investing. This is about life compounding. So people who probably didn't realize that typically compounding is a word used for investing, but let me clarify here that this book is a life compounding. So all of you who have not read this book yet, who have not purchased it, uh, you have to read this book. You have to give this book to your youngsters and family. The earlier people start reading this book, the better they will compound in their respective life. So Gautam, thank you so much. It's been a great knowing you, and I hope you just keep growing and growing and growing and emerge as the next big thing India has sent to global markets. So let's get into your presentation because you have lots to talk there as well. So let's deep dive into your presentation. I think you can share your screen.
Sure. So today I will be speaking about the discipline of investing. And before I begin the presentation, just a standard disclaimer that this presentation is solely for information and knowledge sharing purposes. The examples shown are for understanding concepts and should not be considered as stock recommendations. Stellar Wealth Partners is a SEBI registered research analyst firm. We may hold some or all of the discussed stocks from this presentation in our proprietary accounts or small case model portfolios. It is also possible that we may have exited or may exit from these stocks in future without prior notification. So please do your own research and due diligence for any investment actions and consult a registered financial advisor for the same. Stellar Wealth Partners will not be liable for any claims arising from use of data provided. Neither is there any guarantee for accuracy of data. And most importantly, the views expressed are my own personal views and do not represent the views of any entity or organization.
Thank you.
So this will be the flow of today's presentation. I'll be taking everyone through my investing framework and explain the investing framework through the use of case studies, both past and present from the Indian stock market. And finally, I'll finish the presentation with a brief about how value investing is a life discipline. So all successful investors in the world have a very clearly defined investment philosophy. That investment philosophy in turn is defined by vicarious learning from other people through books, through personal experiences. These are some of the books which have defined my personal investment philosophy. Terry Smith's Investing for Growth taught me how to invest in high quality growth businesses for the long term. Capital Returns, which was edited by Edward Chancellor, taught me the capital cycle theory and the use of it when investing in cyclicals and commodities. And Joel Greenblatt's classic on special situations, You Can Be a Stock Market Genius, taught me how to evaluate demergers and reverse mergers. We'll discuss all of this in the presentation today. This is a brief snapshot of my investment process flow. There is always an existing list of ideas on my watch list and I keep tracking the performance of those watch listed ideas. And I keep checking for management execution and business performance. And to that existing watch list, new ideas keep getting added from time to time through an idea generation process, which we'll discuss shortly after this slide. And then this leads to an active watch list of 10 to 15 potential opportunities, which in turn feeds into the portfolio construction and the portfolio tracking and rebalancing. So let's cover those two aspects first.
Okay.
The portfolio on an average comprises of 20 to 30 stocks, and the aim for me at any point of time is to generate 20 to 25% CAGR on a portfolio level over the next 3 years. I follow a sector and market cap agnostic investing approach with a bias towards under-researched and well-run small to mid-cap companies. There is no hard cap on contribution to the portfolio from any one single idea or sector or market cap range, but I ensure that prudence is maintained at all times. The initial weighting per stock ranges from 3 to 5% at cost, and the occasional exceptional opportunities may get an allocation of 10% at cost.
Okay.
The decision to sell any single stock will solely be based on their business performance or their potential incremental IRR or the potential returns from the current price. And I keep a portion of my portfolio in cash if valuations of existing holdings or the watch list ideas become exorbitant. I track industry trends of my portfolio companies like changes in the competitive landscape, any technology changes in government regulations, any supply chain disruptions, The
Mm.
quarterly results are evaluated against my own expectation, and the performance is benchmarked against that of competitors.
Mm.
And a detailed diligence is carried out in case the investment performance is not as per the initial investment hypothesis.
Okay.
Any particular holding is exited only if the valuations become absolutely expensive or if there is a structural challenge to its business fundamentals.
Mm.
And all the portfolio companies are periodically ranked based on valuations, earnings performance, expected future stock returns, and the rebalance is done accordingly.
Mm.
Any fresh or follow-on investment in an idea is done only if it can deliver an attractive IRR of 20 to 25% over the next 3 years from the current price.
Okay. Just one small thing. Gautam, I'll keep on asking questions in the middle if you allow me to do that.
Sure.
Yeah. So when you say 10% at at cost, that means every time you evaluate allocation in a stock, that will be always at a cost price, not at the current market price.
When I initiate the position, yes, because that will determine the initial weighting, right?
Okay. And suppose you are reviewing everything probably every quarter, then do you do mark to market or it is the percentage is always at a cost?
So once the stock has been purchased, then the ratings are all evaluated based on the current market price. This, when I say allocation, initial allocation at cost, it means that I'll give an example. Suppose I have a portfolio of 100, of
Yeah.
which 90 is invested and
Mm.
10 rupees is in cash. So if I allocate that entire 10 rupees
Mm.
into the portfolio, into a new stock in the portfolio, that means that it has got an allocation of 10% at cost. That is what it means, basically means.
Sure, sure, sure.
But once the
Got it.
initial allocation is done, once the initial purchase is done, then all the stocks are looked at based on current market value. The market value weights are considered after that, after the
Sure,
initial purchase is done.
sure, sure, sure. Got it.
So now we come to the main crux of today's presentation about how do I generate ideas? What is the sources which are used for idea generation? Because a lot of people ask me, what are the sources which you use for generating your ideas? And today I would like to share that in detail with our learning community.
Awesome.
So every day, I diligently review all of the corporate announcements on the Bombay Stock Exchange. It is a painstaking exercise for many, but for me, it is like an intellectual treasure hunt wherein I may strike gold anytime.
Mm.
And I look at press releases, investor presentations, any M&A deal, joint venture or partnership agreements. Whenever I'm evaluating quarterly results of companies on Screener or any
Mm.
other database, I try to look out for breakout earnings. What does breakout earnings mean? It means sales have basically grown more than 50% year on year.
Mm.
Profits and earnings have grown more than 300, 400% year on year. That is called an earnings breakout. And
Mm.
the stock market is very slow to adjust the stock price to the right intrinsic value immediately. So you get what is known as a post earnings announcement drift. Even
Okay.
if you buy the stocks the next day after their earnings report, the
Mm.
previous night, even if you buy them 5-10% higher,
Mm.
that is not the correct intrinsic value. The intrinsic value actually is much higher. But the
Okay.
stock market takes its own sweet time to revalue the stock to the right high level.
Mm.
So watch out for breakout earnings when you're evaluating quarterly results. I also go through con calls of all the existing holdings as well as the watchlist ideas on
Mm.
Trendline, Alpha Street, Research Bytes. And in case of certain micro caps, you can also get their conference call transcripts by going to the company website, investor relations section.
Mm.
I also check what are the global peers are saying. What is their commentary? What is their outlook? This is especially important in commodity industries and chemicals and cyclical businesses like chemicals,
Mm.
because many Indian promoters have a tendency to make very overly bullish statements. So it's very important to corroborate that with what the global peers are saying.
Mm.
Also try to read as many management interviews as possible of all the watchlist companies and the portfolio companies. This can come from various sources in business magazines or articles on the internet or business channels.
Mm.
I use screening tools like the Jory Finance and Screener, and in that I look for companies which are either undergoing a very big capex program or companies which have already completed a very big capex program. I also look for a list of stocks which are hitting 52-week high, all-time high, or a post-IPO new high. Now, let
Yeah.
me emphasize a bit on this last point about post-IPO new high. Many times in the Indian market, you'll notice that companies get a very big listing pop, and then they go into consolidation for 8-9 months or 10 months
Yeah.
or more. And then they again break out after that long period of consolidation. And
Mm.
that breakout after that long period of consolidation generally coincides with some important corporate development in that company. So always be on the lookout for a post IPO new high. And one more very important point I would like to share with all our learners here is that when you're evaluating price action, time frame matters. So immediately after a bear market crash, look for stocks which are hitting a 3-month or a 6-month high. In a mature bull market, which is in late cycle, look for stocks which are hitting multi-year highs. In a non-trending, range-bound or sideways market, look for stocks which are breaking out to 52-week highs. So time frame is very important when you're evaluating stocks hitting highs. Just keep that in mind. I also go through equity research reports. These are some of my favorite broker names whose equity research reports are pretty informative. Ambit, ICICI Securities, Spark Capital, India Infoline, Nirmal Bang, and Axis. I go through the annual reports diligently every year, and credit rating reports are also very, very important because they are a rich source of information. Now, on the credit rating reports, I would like to make an important point here that for many macro cap companies, which have got loans outstanding or may have taken loans in the past, these credit rating reports are often the only third-party source of information available to you in the absence of conference calls and presentations. And you will find such information in those credit rating reports of those macro cap companies, which you cannot find anywhere else. So pay attention to credit rating reports. DRHPs or draft red herring prospectus and QIP offering documents, both are a very rich source of information on any particular industry. As an example, if you want to learn about the music licensing industry in India, you can read the recent QIP offering document of Sargama Limited. So these two documents give you very rich source of information on a particular industry. I also read the investor letters by fund managers whom I admire for their investment philosophy. Some of them are Solidarity, Sage One, and Equirus. They publish very good investor letters. I also try to attend investing conclaves like Tamil Nadu Investor Association or India Investing Conclave, and webinars like those held by SOIC. A less talked about source for idea generation is the fund managers' top 5 holdings from PMS Bazaar website. Now, the sign up is free, but very few people know about this particular source. You can actually log into this website and get the top 5 holdings and weights of fund managers whom you admire and respect in the stock market in India. So this is a very good source for idea generation. And thanks to you, Vivek, and thanks to the Stock Edge app, that's a great source of idea generation through information on bulk deals, block deals, and insider buying. And I also look at the 52-week high volume list on a daily basis, because anytime a stock experiences a 52-week high volume, something generally tends to be happening in that particular company. It can be on the upside or the downside, but something interesting is happening. So then I start looking up the news articles on that particular company. What has exactly happened in the last 1 month?
Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.